This is Chad Staskal, Managing Partner here at Eagle Wealth. My goal today is to update you on some of the recent economic headlines, as well as some ideas to consider in the current environment. And I have a lot to cover, so I'm going to jump right into it. I'm going to start with monetary policy. Monetary policy is a set of actions available to a nation's central bank to hopefully achieve sustainable economic growth. And they do this by adjusting the money supply, such as increasing and decreasing how much it costs you to borrow money. Managing a change in the direction of monetary policy is very difficult. More so when the central bank's top priority is to keep inflation low, which it is right now. And if the Fed moves too slowly, the economy has to deal with the severe consequences of high inflation for too long. If they move too quickly, and there's a risk of putting the economy into a recession. Federal Reserve Chairman Jerome Powell is attempting to navigate a soft landing, which occurs when the Fed raises interest rates enough to bring down high inflation by slowing economic growth, but not enough to put the economy into a recession, or what the Federal Reserve would consider a hard landing. The Consumer Price Index, a measure of how much things cost for inflation, has increased to 8.5% year over year, a level we have not seen since 1982. This is well above the Fed's target rate of 2%, and the Fed is strongly committed to taking steps that will reduce inflation. One of the ways the Fed can help fight inflation is by raising short-term interest rates. The Fed plans to raise the federal funds rate to 1.9%. Higher than the level it was before the pandemic started. These higher rates means it will cost more to borrow money, which will hopefully lower the amount of stuff people purchase, which also hopefully slows the increase of the price of that stuff. For longer term interest rates, the Fed plans to reduce the size of the bonds it currently holds. During the pandemic and the aftermath, the Fed aggressively bought Treasury securities and mortgage-backed bonds to drive down intermediate and long-term interest rates. They amassed almost $4.5 trillion in bonds. And it worked. Interest rates came down, households could refinance debt at a lower level, provided a higher level of cash flow, and that could be used for spending, which drove economic growth. Well, that's no longer needed. So the Fed will allow some of those bonds to mature each month. This will help put upward pressure on the longer-term interest rates. And Powell recently cautioned that monetary policy is a blunt instrument. It's not capable of surgical precision. Nevertheless, he also stated the Fed managed soft landings, not a recession, in 1965, 1985, and 1994. And most economists think the Fed was on track for achieving a fourth soft landing ahead of the pandemic. So let's take a look at what's driving markets right now. Although stock market and bond prices have both had a very difficult start to this year, the U.S. equity markets have rebounded approximately 6.5% from the March lows. They are dealing with climbing several walls of worry, though. This includes the ongoing war in Ukraine, higher inflationary pressures, and an increasingly more aggressive Fed. But given positive fundamentals, we still continue to see a possibility for modest gains over the next 12 months. However, we expect markets will remain volatile, as is usual. As investors attempt to navigate a more balanced landscape of risk, further pullbacks ahead are definitely possible. And until the uncertainty surrounding those key concerns are subdues, we still are at that risk. Here's a small set of some of the indicators that we are watching. First off, the labor market. Payroll growth continues to grow at a rapid pace, which is being supported by more people re-entering the workforce. This is good for the economy, but it's also a part of the higher inflation concern as costs go up due to higher wages. And with interest rates, the Fed plans to push up those short and longer term interest rates in an effort to slow the economy and inflation, as we stated before. Slowing down an economy makes it harder for companies to make as big of a profit and increase their stock price, which could make it harder for the stock values to go up, as we've seen in the past at the higher levels. The housing market will most likely slow down based on a combination of higher home prices and rising mortgage rates, which is causing mortgage payments to move significantly upward. This will make it harder for families to buy a home and most likely slow the increase of home values. Consumer spending is the largest part of our economy, and the pace of growth in household spending has slowed in the recent months, which is helping bring the economy back into balance. Controlling the balance of consumer spending and inflation is a tight wire act at this point. As mentioned earlier, the CPI hit a 40-year high of 8.5% year over year, but it's expected to start declining over the course of this year. With receding cases of Omicron and workers returning to the office, demand for services like restaurants is picking up, and I know we're all very thankful for that. It's not easy sorting through the economic noise these days. That's why our team examines a variety of indicators like the few I covered. If we see a need for a change in your portfolio, we'll explain why we're charting a new course. But there's not much new perspective on the current events in the last month. Markets are still locked in a volatile pattern, which is probably going to continue for that way in the near future. But we're watching the data closely. So today, I have a big picture question for you, if you're interested. While absorbing the recent news, it's easy to think that the world is going off the rails. There's a global pandemic, worrying inflation, conflicts in Ukraine, and unprecedented developments, it seems, everywhere. So let's ask the big question. Is the world getting worse, or is it actually getting better? I've had multiple clients come in saying, I feel like I've never felt before. Is the world going off the rails? And honestly, I'm not sure that question can really be answered. I imagine you've heard the statistics of how far the world has come in terms of measurable progress. It might be nice to know global poverty is down, or that the rate of people killing people is historically low. Although that's not really helpful when you're getting gouged at the pump, your kids are homesick, and you're seeing images of ruined lives on the news. For the first time in human history, we can instantly communicate with folks thousands of miles away and see what they're doing. We have access to real-time news from everywhere in the world, and because of how the news is constructed, unfortunately, it's nearly always bad stuff that gets our attention. Most people spend hours each day consuming media of one kind or another. And the question we ask each other has changed from, how are things in your neck of the woods, to, have you heard about, and insert the crisis of the moment. We're human. We live our lives day to day we're inside a fairly small bubble. And that bubble is easily influenced by daily stresses, media filters, and our own outlook on the world. So what do we do? How do we fight this dread of negativity? We need to know how to put things into perspective for ourselves, for our children, and young people who look to us for guidance, and for our loved ones, who might need a boost. So here's a few ideas that we've worked out within our team. 1, invest time in relationships with people we love and care about. Be selective, especially in the news and the media that we consume. Follow our faith, if we have one. Volunteer, donate, be the change you want to see. We talk about this in our office quite a bit, and why we focus so much on community service. I'll close by asking you, how are you doing today? And do you have any questions about what I've covered today? If so, don't hesitate to call us. We're here to help. Now, for that pesky mandatory disclosure, please remember, nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, feel free to give us a call. We'd be happy to talk. Once again, this is Chad Staskal with Eagle Wealth Management, signing off.